As investors wait for a debt limit decision, confidence in the economy is taking a major hit. University of Michigan's Consumer Sentiment Index for May coming in worse than expected, falling to its lowest level in about 6 months. For more on the state of the economy, we want to bring in Nathan Sheets, Citi Global Chief Economist. Nathan, it's good to see you here. So certainly just reflected in the University of Michigan print, obviously consumers getting a little bit more nervous about where the economy is headed. What are you seeing and the data that you're looking at in terms of consumer spending and how people are adjusting?
I think the general tone of this Michigan survey is very consistent with my impression of the economy, that on the one hand, the absolute level of the reading remains above 50, suggesting that the economy continues to expand, that consumer confidence on balance is reasonably good still, but it is a notch softer than it was before. And I think broadly speaking, we're seeing that in the economy, that it is gradually slowing, that the Fed's rate hikes are starting to have effects. The consumer's red-hot expenditure on services is starting to slow a bit. We're probably still several more months of strong spending that are in the pipeline. But our sense is by the time we move into the fourth quarter, we're likely to be seeing a more marked slowing and possibly even a recession.
Yeah, I mean, it sounds like looking through notes that you think things aren't great, but they're not as terrible as the headline suggests. I wonder to what extent you think the banking crisis has really hit confidence at the consumer level. We've been trying to make sense of some of these moves in the market, but if you talk about a sentiment, to what extent has that been hit as a result of what we've been seeing in the financial sector?
This is a really important question. And when I look at this Michigan survey, what's really striking is that expectations component, where people are asked, what do you think the economy is going to be like in 6 to 12 months? That reading fell quite significantly and is softening up at a fairly rapid rate. And you kind of step back and you say, well, what might be driving that? And I think part of it is Fed rate hikes. But I think also people are taking note of some of these banking sector stresses, and it's causing them to be a notch more cautious about spending and their attitudes going forward. And for what it's worth, this past week, in the Fed's senior loan officers survey, we also saw some marked evidence that firms were pulling back on their demand for credit. And I think for very, very similar reasons. So I think it is fair to say that these headlines that we're seeing of financial stresses, of bank failures, of financial uncertainties are weighing to some extent here on consumers, on businesses. And I think they will ultimately weigh to some extent on spending in the economy and be another downdraft over the next, say, 3 to 6 months.
Nathan, the high probability that you were referencing before in terms of a recession in the fourth quarter, maybe starting to show signs of the recession in the fourth quarter. How deep of a recession are you expecting?
Well, our baseline is that by historical standards, the recession will be relatively mild. And by that, we mean maybe it lasts a couple of quarters. The unemployment rate will rise from roughly 3.5% at present up to somewhere in the 5.5% range. This will be a painful event, but by historical standards, relatively mild. Now, if in addition to Fed rate hikes and some pulling back by consumers and firms in their expenditures, if in addition we're seeing continued financial headwinds and market pullbacks in credit and tightening of credit conditions, then I think we have to consider the possibility that the recession might be deeper and more long-lived than what I just described. But that's not our baseline. That's a downside case, but it's one that we're thinking hard about given current circumstances and is certainly one that we put some probability on.
Nathan, what's the one risk, downside risk, that you think the markets are overlooking right now?
That is always a tricky question to answer, because I think the markets are very effective at monitoring and finding risks. As I've said, we're certainly very worried about various aspects of the banking sector situation. And we're also watching closely and worried about the debt ceiling and everything that might mean. But if I were to move beyond that, inevitably what I've seen in my career is that when we all get grim, we're surprised on the upside. And when we all get bullish, we're surprised on the downside. So maybe the upside that we're not thinking hard about sufficiently in detail is, over the last several years, the U.S. economy has shown extraordinary resilience. And maybe we're underestimating the possibility, notwithstanding all of these risks and shocks, maybe we're underestimating the possibility of a soft landing, and that the economy, as it has shown over the past several years, remains resilient and performs better than we had expected.
I like that, Nathan, the optimistic outlook there on that, the fact that maybe we could see a soft landing. Nathan, how do you think the Fed has been looking at all these data points that we've gotten out over the last week or so, the latest employment report, the latest readings on inflation, and what that means for the next meeting next month?
I think these numbers set the Fed up to have a very vigorous debate about the next stages of policy. I would say, on balance, that payrolls report will provide ammo for those that are more hawkish, that we're still creating a lot of jobs. And the average hourly earnings number in that print was very strong. In contrast, the CPI report showed some hints of maybe softening, and certainly the markets liked where the services inflation number was, and particularly the non-shelter services, and maybe that provides a little bit of fodder for some of the doves. But it really feels to me like that the Fed has a vigorous debate about where the economy is at the moment and how to think about these ongoing financial sector stresses that continue to percolate. And what is the appropriate policy? What's the right setting of monetary policy given those financial stability stresses as well? Our feeling is that it will be a close call, but that on balance, the Fed is likely to hike another 25 basis points at this next meeting, but to continue to make clear that it's going meeting by meeting and it's watching the financial stability, the banking sector risks very closely, and is prepared to respond as necessary to them.
Yeah, it certainly has been the message from Powell from the last couple of meetings. Nathan Sheets, great to have you, Citi Global Chief Economist. Have a good weekend.
Thank you.